Guys, they want to take my Excel. They want to take my Excel. Guys, I just created a video on liquidity, and if you have been finding it difficult to understand liquidity and how you can spot liquidity and trade liquidity, this video is for you. Liquidity is just like an oxygen, right? And once you notice it's gone, you start panicking. Guys, no let institution run you. Try to use this thing. Make institution not be the run, not the run us. This no be jaw, right? So let's go to the chat and let me explain things.
What's up, traders? You're highly welcome to today's series of the video where we'll be discussing liquidity, right? And we'll be discussing liquidity in these various aspects, defining liquidity, then try to identify the types and where liquidity can be spotted in the market, right? Then how to trade liquidity in just these three simple steps. What is liquidity, types, and where they can be spotted on the chart, then how you can trade liquidity. Without wasting time, let's get to business. What is liquidity? Just see liquidity as money. Your Excel levels are where your liquidity reside. It has to do with volume. Liquidity is money in the market, and it has to do with volume. Just have this basic understanding about liquidity, that liquidity is money and it has to do with volume. It is associated with how quickly or easily a currency pair can be bought or sold. Now, the most liquid pair as believed in the market is Euro USD, right? So it is believed that it is the most traded pair globally. The Euro USD pair is believed to be the most liquid pair. Who are the drivers of liquidity? They are the hedge funds, the institution, the big banks, smart money, right? They are the ones that drive liquidity in the market. Now we move to the types of liquidity. There's a good number of liquidity types that exist, right? The various types of liquidity has to do with where they can be spotted. For example, let me move this way. Now, liquidity can be spotted above equal highs and equal lows. That is to say, in a ranging market scenario. That's the first one. Just note these two simple areas where liquidity can be spotted. The first one is what? Above equal highs and equal low in a ranging market. Take for example, this is a range, right? And there's a price movement this way, ranging inside this zone, right? So liquidity can be spotted above these highs. There's a saying that liquidity is always seen at trend lines, right? So there's liquidity above these highs, there's liquidity above these lows that are serving as a support, right? There's people's Excel, for example, people that are trying to buy, right? People that are entering the long position are placing their Excel down this side and they're targeting upward, right? In the same manner, people who are also trying to do what? To go short in the market are placing their Excel here, right, above this level, and they want to go short in this manner. But something always do happen. When smart money comes into the market with their billions and millions of naira, they want to move the market in a particular direction. So let's take, for example, the engineer liquidity from here, then sweep above this high, taking off all the whole liquidity that is resting above these equal highs, right? Taking off all this liquidity up before actually trending down, right? And also in this manner, they also sweep liquidity, the whole liquidity resting below this support level, right? And the market continues downward. That is just how a liquidity sweep occurs in equal highs and equal lows. That is to say, in a ranging market, right? Now, liquidity can also be spotted. This is the first scenario that I want to show you. And liquidity can also be spotted in old highs and old lows, right? That is to say, the external and the internal range liquidity. This is a swing, for example. This is a swing, this is a swing high, this is a swing high, right? Obviously, this is a high. This is a high and this is a low, right? In a structural market, right? Above highs and lows. Liquidity always reside above highs and lows. So this is it, this way. And there's a break of structure from here. Markets continue this way and rallies this way, right? Now above this high, there's liquidity here, all right? There's a liquidity here, there's liquidity here. That is to say, traders who are trying to go short from here, right? And also below these lows here, there is liquidity, all right? There is liquidity here. Traders who are trying to go long from here will place their XL here, right? For this swing, this is the origin of the swing. For those trading other blocks, there's an order block here, right? There's an order block here. There is another order block here, but this order block is kind of serving as an inducement, that is to say a trap, as traders trying to go long will now say, okay, there's a new order block here. There's a new order block here, but this is just an inducement, a trap to bring more traders, buyers into the market. And what does smart money do? The hedge fund, they take trade above this high, sweeping off all this liquidity from this high, rally the market up and clean off this liquidity resting here below these lows here down to this origin. So there's a liquidity sweep here and also there's a liquidity sweep here, right? This is for an upward movement. Those trading the M and the W pattern will understand this better. Now also in a downward movement, price is moving this way, right? Price tend to move this way, rally up, create another low, right? Engineer some liquidity and we'll be trying to continue downward in this direction, right? Now this is the origin of this swing from here. Let me use this is the order block of this swing, right? And price is rallied up and this is an inducement, as traders will feel as if this market is still in the same direction. This market is still following the downtrend direction. So buyers will also from here see this as a new what? As a new order block to go short. Or something happens, smart money comes into the market, engineer the liquidity, sweep up this liquidity and continue upward, right? And start trending in the upward direction. Let me show you this scenario in chart. All right, so let's get into the chart. Let's move to the chart, and also after that I'll now also be showing you how you can trade liquidity. So let's go to the chart and see these examples. So guys, this is an example, right, of a ranging market. This is a 15-minute time frame, and as you can see from here, this price has been in this zone for, let's say, roughly 8 to 9 hours plus, because this is a 15-minute time frame, right? So it has been ranging in this market. Now something happened above these highs, above this trend line. There are liquidity resting on this line because sellers are here, those trying to go short, right? And also below this support level, there is liquidity resting below this place. Buyers are here trying to go long, right? So there's liquidity around all this area, below this line, above this resistance level. There is liquidity. There are buyers who are willing to go short, right? Below this place, there are sellers who are willing to go long, and the sellers XL are here, while the buyers XL is also located here. Now, what did price do in a ranging market? Now, price rallied up, right? Cleaning off all this liquidity above this area, swept it off, right? As if it wanted to trend in an upward direction, and it now do what? It now retraces down, right? Cleaning off as well the XL, that is the stop loss of the buyers the buyers from this zone, right, and now rallied down. That's an example of liquidity in an equal high or in a ranging market, because as you can see from here, you can see the momentum. From here, you can see the momentum with which this red candle rallied down is a force. And this is the work of the institution. Smart money came into the market and pushed price down here, sweeping off this liquidity that was residing above these highs and also liquidity that was resting below this low. Let me also show you another example for better understanding. So guys, this is a clean setup. This is a clean setup. I just marked out this setup for you to be able to understand what we are discussing, right? So from here, let's analyze this. Let's analyze this. There's a sweep here. You can believe with me that this is an equal high from here, right? This is me in chart, right? There's an equal high here. And what did this up candle do? As you can see, it has a great momentum. There's a force here sweeping off this liquidity above these highs and took the market downward, right? That's another scenario of a liquidity sweep, right? This is a liquidity sweep here. It swept off all these liquidity resting above this high, then it rallied down. Let's proceed into this ranging market. As you can see, buyers at this stage will place the XL here, and of course you know that XL is money, right? So once price hit your XL, of course you'll be in a loss. So XL are money, and traders who are willing to go short to place the XL here, right? And also there's XL here for traders who are willing to go bullish, right? So there's liquidity resting above all these highs. These are money, right? XL traders, retail traders, XL, and also below this place is also XL. That's liquidity resting below these levels, right? So what happened? What now actually happened? Traders at this point, using this confirmation, right, will see that okay, this is a fair value, there's a fair value gap here, there's a fair value gap here, and using the field retracement tool, you can see that this fair value gap is actually in the uptrend, right, at premium. So, and this kind of rallied into that position, that fair value gap position, right, creating a gap there as well. So these two candle, this red candle will give buyer an indication that okay, it's like this market is not actually wanting to what, to trend down, right? It will serve as an indication that okay, we're in the premium and we're in the premium of this range, and this market is actually trying to go down with the appearance of these red candles here, and also it has already given that is in the premium level and there's a fair value gap with the confirmation to go short. Now something happened. Traders will now place their XL here and targeting this profit downward. What did smart money do? Smart money comes into the market. When they came into the market, they rallied the price. It's not that as if these traders were wrong. They were actually correct because this price actually went down, right? Now smart money came into the market with this full force. As you can see from this candle has a very great momentum. So it aggressively rallied up, right? Sweeping off all this money resting above this resistance level, swept off this SL of retail traders, right? As if it's going to go bullish, but something happened. It made a new direction and started trending down. Of course, sweeping off this buyer's liquidity here as well, right? Sweeping off those liquidity here. That's an example of liquidity resting above equal highs and equal lows, or in a ranging market scenario, a liquidity sweep or grab above equal highs and equal low. To me, what do you think? What do you think? You can just discuss something with me in the comment section. What do you think? Because I think it can actually happen for a trader's XL to be hit from here, since it is unexpected. But any trader that this down candle rallied down to come and clear their SL, I think maybe it's they are greedy traders or something, because obviously from this, when you're measuring this down, this is a good number of pip that you can just exit. I don't know, what do you think in the comment section? Do you think that this trader who has been longing from here and suddenly start seeing a downward candle would have exited the trade, or even waiting for that trade to hit the XL? What do you think? I don't think The wise trader will watch this market rally down to come and hit their XL and taking them off the market and giving them losses, right? So let me also show you an example of liquidity sweep for a structure, right? That is to say highs and lows. Now for this scenario, this is actually a bullish movement, right? This trade was trending up. Now at this point, right, traders will easily see, okay, it's kind of trying to move downward now, so they'll place the XL here, right? They'll place the XL at this level and waiting for this market to go short. Whereas traders at this level will also say, okay, this market is trying to go bullish, so they'll place the XL below this level and target this height to take their profit, right? But when smart money came into the market, you can see the momentum, you can see the aggressiveness with which this market rallied down, right? So what did smart money do? It came into the market, swept off this liquidity, that's this XL residing above this high, right? In an uptrend, they swept off the liquidity from here and the market aggressively rallied down, of course, taking off the XL of these buyers residing below the support level, taking off the XL of those buyers, then continue the downward movement. So that's an example of how you can identify liquidity in the market and how they are swept by smart money. Let me now quickly show you how you can trade this liquidity, right? So to trade this liquidity, guys, you have to go to a higher time frame. You have to go to the higher time frame, right? So let me quickly use a higher time frame, and let's say the 1 hour time frame, all right? So on a 1 hour time frame, what do you want to do? You want to mark out highs and lows, right? On the higher time frame, that is to say, identifying highs and lows on a 1 hour time frame, because you know it's at this high and at this low that liquidity is resting. So you want to mark out all those highs. So let me just look for the charts. So from here, guys, this is a 1 hour time frame. Now using this level, because this is a high, right? This is also a low. So I'm trying to use the most recent high to explain this. This is a high. Let me just put a trend line there. Let me mark this out with the trend line. There's a high, right? At this level, and also defining this range. There's a low here, actually. There's a low here, right? So you just want to mark out your highs and your low, because you know liquidity are resting below and above those high and low. The next thing you need to do is to note the structure, right? Note the structure. From here, you can see this, it changed structure from this place because it broke this structure, right? And started trending downwards. And always have to trade with the trend, right? You always have to enter the trade with the trend. So this is a downtrend, but there's a high here, there's a low here. So the next thing you need to do after noting the structure, since we just agreed that is a bearish scenario, that's the expected direction, then the next thing is to move to the lower time frame, then wait to see a sweep above that very high, that is above this very high on 1 hour time frame, to give us an indication. It's already showing an indication here. Actually, it swept above this high and there's a fair value gap here, giving a strong confirmation to go that same direction, to go low. But I think we can actually see this from the lower time frame very well, right? The indication that it's going to go low, that it's going to go bearish. So we wait for a sweep. Once you move down to the lower time frame, you wait for a sweep above the high that we've marked on the 1 hour time frame. And once it sweeps above the high, you want to enter a trade, right? Because it already took off liquidity, swept above this high. You want to enter a trade, like placing our XL above the liquidity sweep. That is to say, let me move down to the 15-minute time frame to show you this. Now from here, this is the 15-minute time frame. This was the high that we marked, then this is the low, right? Now wait for this price to sweep above this liquidity the way it just did from here, right? Because we don't want to be a liquidity to the market. We don't want to be an inducement to the market, right? So wait for this liquidity to sweep above this high, because as you can see, this is a liquidity sweep. It is not a liquidity run. If it is a liquidity run, it will retrace and continue its movement, but this is a liquidity sweep, swept above this high, right? So you want to see a sweep above this high. Then what do you do next? You now place your XL above the liquidity sweeps high and targeting down. What do I mean? You now place your XL from here. Where is the short position to? Because this is our trend. We're in a downtrend. You now place your XL above this now place your XL above after showing an indication to move down with a fair value gap here, right? With this bullish order block and a fair value gap showing a good indication to go low. So you now place your XL above the sweep, right? Then targets down, right? As you can see. And this market still have willingness to even trade down. This is the most recent chart. It's ranging here actually, but it still have willingness to go down. So see, I think our XL is much, so I just reduce it this way, right? So for now, is a 1:3 risk reward ratio, and if you measure the pips, you can see the number of pips from here. And that's how you can trade liquidity around 54 to 58, right? Or thereabout. That's how you can trade liquidity. You just have to note the highs and the low on higher time frame, mark it out, toggle down to the lower time frame. You want to see a sweep above that liquidity, then give me a confirmation to go either the direction of the current market trend, then placing your XL and executing the trade right on the lower time frame. And with this, we come to the end of the video. I hope this was also helpful as usual. Please do not forget to subscribe to the channel and also turn on notification. See you in the next one. Bye.